Good morning, students. In the previous session, we have discussed about the Walter's model of dividend policy. James E. Walter, who has proposed a theory to be called as Walter's model, in which he has focused on two elements for determining the dividend policy. What is that? That is, number one is return on investment or internal rate of return, that is R. And another element is cost of capital or rate of return, that is KE. So these two elements that will determine the dividend policy of a firm. For that, he has classified the firms into three categories. The first category of the firm is what growth firms, and another one is normal firms, and the last one is declining firms. Last session we have worked out some problems related to these three firms in respect of Walter's model. Now we are going to discuss about the Gordon's model of dividend policy. So what is it, Gordon's model? This is another popular model that has argued that dividend are relevant and a dividend decision of a firm which will affect the market value of the shares. Actually, this model was proposed by Myron Gordon. According to this model, a firm's market price is determined by the dividend payout ratio. This model uses stock valuation using dividend and capitalization approach. Okay, so this is the concept of Gordon's model. Okay, next, what are the assumptions of this model? This model is based on certain assumptions. What are they? The firm is all equity firm and it has no debt at all. Actually, this firm is totally depending upon the owner's capital. Owner's capital, this is what is equity capital. Next, it has no debt at all. It has not issued any debentures. It has no fixed dividend bearing stock, that is to be called as a preference capital. It has alone what the equity capital. Number two, the second assumption is all investment projects are financed by exclusively retained earnings. In other words, no external financing is available. Suppose you see that in future the firm which wants to expand its business, it will receive only the equity finance, or it can utilize what is called the retained earnings that has been maintained, that has been retained with the business in the form of what? Reserve fund or general reserve or accumulated profit, whatever it may be. Only that amount that will be utilized by the firm for making investment. Next, third assumption is the rate of return on firm's investment is constant. What is it? Always the rate of return would never be changed in future. For the next 10 years or 15 years, the rate of return that will remain constant. There is no fluctuation in rate of return. And that is another assumption. The next fourth assumption is the cost of capital of the firm that remains constant forever. Cost of equity. Here we are using only the equity capital, so that the cost of equity that will remain constant forever. There will be no fluctuation in cost of capital, so that the cost of capital is greater than the growth rate. That is also assumption. The cost of capital will always be greater than the growth rate. Next, the firm's stream of earnings is perpetual. The stream of earnings is perpetual. It will be the firm is in future that will earn only the profit. It will be continuing for the next 10 years or 15 years, whatever it may be. There is no doubt at all. Next, the firm has perpetual life. Perpetual life in the sense what? The existing shareholders may sell their shares to other public, or the other public may invest their amount in the firm's share, company shares. That means what? Men may come and men may go, but the firm will be functioning as usual. There is no winding up of the firm. In case if the shareholders who will be selling their shares to the outsiders, there will be no winding. It will be continuing its business. It will be earning profit. The profit will be constant forever. There is no doubt at all. The next term, the retention ratio, that is B, once decided upon, is constant. The retention ratio that is already decided, that remains constant forever. The growth rate B and R. Growth rate means what? B and R. That will be remaining. That will remain constant forever. Okay. Next, there will be no corporate taxes in future. No corporate taxes. So these are the assumptions of the Gordon's model. Right? Okay. What is the formula for Gordon's model? I mean, Gordon has provided a formula to determine the market price of a share or market value of the share. Okay, what is the formula? Market value per share, that is shortly termed as P, is equal to D by K minus G, or E into K minus B divided by K minus BR. So that is the formula. The first one is first formula, D divided by K minus G is the shortest formula. I mean, the students can use that formula alone. Okay. Next, what is dividend? D is equal to dividend per share. K is equal to cost of capital. G is equal to growth rate. That is B into R. What is B? That is the retention ratio. R, that is rate of return. If you multiply the retention ratio by R, can get what? The growth rate. Next, E, earnings per share. So this is the formula for finding out market value per share as per the Gordon's model of dividend policy. Next, what are the implications of this model? The optimum payout ratio for the growth firm is nil. The optimum payout ratio for a growth firm is nil. Number 2, the payout ratio for a normal firm is irrelevant. Number 3, the optimum payout ratio for a declining firm is 100%. Once again, I repeat the implications. The optimum payout ratio in case of a growth firm is nil. The optimum payout ratio for the normal firm is not relevant. That is irrelevant. The optimum payout ratio for a declining firm is 100%. So that is the implications. Next, criticisms. Actually, assumption of 100% equity financing is not at all possible. That will defeat what the objective of maximization of the wealth of the shareholders, the wealth of the firm. What does it mean? Then 100% equity finance. There will be, it has been assumed that 100% equity finance. There will be no debt finance. It means there will be no leverage. Suppose if there is no leverage, the financial objective of the firm, what is that? Maximization of wealth of the firm is not at all possible. It's not at all possible because of, because there is no leverage at all. So if there is a leverage, it means what? The firm that has used a debt finance. Here it has been assumed only the 100% equity finance, there is no debt finance. So that leverage is not at all possible. If there is no leverage, that is maximization of the wealth of the firm is also not possible. Okay, second one is constant rate of return and current opportunity cost are not in tune with the realities. So what is a constant rate of return? Okay, every year we cannot see that, we cannot find the same rate of return for the next 10 years or 15 years continuously. Definitely the rate of return that will be, fluctuating. That may be increasing or decreasing, correct? Because of what? The future is uncertainty. Possibilities are there for risk. So that there is no constant rate of return. So that is also another criticism of the Gordon's model. Next, we are going to discuss the problems related to Gordon's theory of dividend policy. Please find the problem on the screen. The following data relates to Enina Limited. Earning per share rupees 14, capitalization rate 15%, rate of return 20%. Determine the market price per share under Gordon's model if retention ratio under three circumstances, that is, in the first circumstance 40%, second 60%, and third 20%. Okay, three retention ratios are given. Under these circumstances, what will be the market price per share? Here, the retention ratio 40%. How did you, what will be the payout ratio? 100% is the retaining. Of this 40% is retained with the business. Remaining, how much is there? 60%. So 60% is distributed as a dividends to the shareholders. So that 60% is the payout ratio. So what is the formula? D by K minus G. D is equal to dividend per share. That is EPS into payout ratio. 14 rupees into 60% is equal to rupees 8.40. That means 8 rupees and 40 paise. What is cost of capital? That is 15%. That is given in the problem. What is growth rate? That we have to find out. To find out growth rate, what is the formula? B into R. B means for retention ratio. R means rate of return. So 40% into 20%. That is 40% into 20% is equal to 0.4 into 0.2 is equal to 0.08 into 100 is equal to 8%. Market price per share is equal to D, 8 rupees and 40 paise divided by K minus G, that is 15% minus 8%, that is 8 rupees and 40 paise divided by 7% is equal to rupees 120 is the market price per share. Next, in the second case, 60% is the retention ratio. So what will be the payout ratio? 100 minus 60% is equal to 40%. So what will be the market price per share under this circumstance? That is D is equal to dividend per share. That is 14 rupees into 40% is 14 into 40% is equal to rupees 5.6. 5 rupees and 60 paise. G is equal to growth rate, that is B into R is equal to 60% into 20%, that is 0.6 into 0.2 is equal to 0.12 into 100% is equal to 12%. Market price per share is equal to 5.6 divided by 15% minus 12% is equal to 5.6 divided by 3% is equal to 186 rupees and 67 paise. So that is the market price per share when the retention ratio is 60%. Suppose in the third category, if the retention ratio is 20%, what will be the payout ratio? That is 80%. Then dividend per share is equal to 14 into 80% is equal to rupees 11 and 20 paise. G is equal to growth rate, that is B into R is equal to 20% into 20%. That is 0.2 into 0.2 is equal to 0.04 into 100 is equal to 4%. What is the market price per share? That is 11 rupees and 20 paise divided by 15% minus 4% is equal to 11.20 divided by 11% is equal to 101 rupees and 82 paise. So what is this? It means what? The rate of return is greater than the cost of capital. So it is called as a growth form. Right. Next time, another problem and for normal, another form under Gordon's model. Next problem for normal form under Gordon's model. There is Breeze Limited gives you the following information. EPS, earning per share rupees 45, cost of capital 18%, return on investment 18%. As usual, three circumstances are given, and the first circumstances the payout ratio is 30%, second 60% and 19%, 90%. Okay, now you have to find out the retention ratio. Then how to calculate the market value per share? First payout ratio 30%. Then what will be the retention ratio? It will be 70%. I mean 100 minus 30 is equal to 70%. So market value per share is equal to D by K minus G, that is the dividend per share, is equal to EPS into payout ratio, that is 45 into 30% is equal to rupees 13.50, that means 13 rupees and 50 paise. Then K is equal to cost of capital, that comes to 18%, G is equal to growth rate, that is B into R, that is 70% into 18%, that is 0.7 into 0.18 is equal to 0.126 into 100 is equal to 12.6%. Market value per share is equal to 13 rupees and 50 paise divided by 18% minus 12.6%, that comes to 13.50 divided by 5.40% is equal to rupees 250. Then the market price per share under this model is rupees 250. Next, if the payout ratio is 60%, then what will be the market price per share? Here the 60% is the payout ratio, retention ratio is 40%. So D, dividend per share, is equal to 45 into 60% is equal to rupees 27. Growth rate is equal to B into R, that is 40% into 18% is equal to 0.4 into 0.18 is equal to 0.072 into 100% is equal to 7.2%. Then market value per share is equal to 27 divided by 18% minus 7.2% is equal to 27 divided by 10.8%, that is rupees 250. Then market price per share comes to 250. Next, payout ratio is 90%. What will be the retention ratio? That is 10%. Under these circumstances, what will be the market price per share? That is D is equal to 45 into 90% is equal to 40 rupees and 50 paise. G is equal to growth rate, that is B into R, that is 10% into 18%, 0.1 into 0.18 is equal to 0.018 is equal to 100 into 100 is equal to 1.8%. Market value per share is equal to 40 rupees and 50 paise divided by 18% minus 18%, that is 40 rupees and 50 paise divided by 16.2% is equal to rupees 250. That is market price per share. Then it's a normal form because the rate of return that is equal to cost of capital, because the share price that remains constant for the different payout ratio. Next step, if it is a declining form, then what is the problem? Just look at the screen. Perkins Limited earns a profit of ₹35 per share. The rate of capitalization is 15%, that is cost of capital is 15%, and the productivity of retained earnings is 10%. Using Gordon's model, determine the market price per share. The payout is 20%, 40% and 70%. Okay, how to calculate the market price per share under this Gordon's model? The payout ratio is 20%. What will be the retention ratio? 80%. Market price per share is equal to D by K minus G. D is equal to EPS into payout ratio, that is 35 into 20% is equal to 7. Then K is equal to 15%. G is equal to R, B into R, that is 80% into 10%, 0.8 into 0.10 is equal to 0.08 into 100 is equal to 8%. So market price per share is equal to 7 divided by 15% minus 8%, that is 7 by 7% is equal to rupees 100. Okay. Then the market price per share that comes to rupees 100. Next time, payout ratio is 40%. What will be the retention ratio? That will be 60%. So the dividend per share is 35 into 40% is equal to rupees 14. So growth rate is equal to B into R, that is 60% into 10%. That is 0.6 into 0.10, that is 0.06 into 100, that is 6%. Then the market price per share is 14 divided by 15% minus 6% is equal to 14 divided by 9%, that is 155 rupees and 56 paise. In third circumstance is payout ratio is 70%, the retention ratio is 30%. Dividend per share is equal to 35 into 70% is equal to 24 rupees and 50 paise. G is equal to B into R, that is 30% into 10%. 0.3 into 0.30 is equal to 0.3 into 100, that is 3%. So market price per share is 24 rupees and 50 paise divided by 15% minus 3% is equal to 24.50 divided by 12% is equal to 204 rupees and 17 paise. So this is a declining form because return on investment is less than the cost of capital. Okay, so these are all the problems with regard to Gordon's model. Thank you.